So when it comes to your salary, realistically, you can get approved for a mortgage no matter how much you make. So even if you don't make a lot of money, that actually doesn't take you out of the game in terms of getting a mortgage. I know it seems crazy. Money is definitely important, but there are two really important factors that are even more important when it comes to qualifying for a mortgage. Something that will take you out of the game is your credit score. What your salary is impacting is going to be how much of a mortgage you can get. With the FHA and conventional loans, with those two loans that are most common, the reason why a lot of lenders give out these loans is that these loans are backed by the government. So if, for example, you don't pay, there is an extra layer of security for the bank where it's going to be bought back by either Fannie Mae or Freddie Mac, and they aren't going to lose all their money. So in order for the bank to have this extra protection, they have to have a certain minimum criteria in order to make that happen. And one of those things is credit scores. So whether you're getting an FHA loan or a conventional loan, there is a minimum number, a minimum credit score that you need to even be considered for those loans. There's no minimum amount of income for you to get a mortgage. So if you have less than that number, then you doesn't matter what your income is. You'd be making 400,000. Like, you cannot get this type of loan specifically. If so far this is helpful to you, go ahead and hit that like button. For an FHA loan, you only need a 580 credit score to be able to get this type of loan. And for the conventional loan, 620 is the minimum for that generally. So some banks will move that up a little bit because they want less risk in the loans that they're putting out. But generally, if you have a 580 credit score, you can get an FHA loan. Some banks go even lower than that. And if you have a 620 credit score, you can get a conventional mortgage. Now, in addition to having to meet those minimums for your credit score, something that your credit score is also going to impact is your interest rate. Banks are not loaning out money just because they want to be nice humans, right? They're lending out this money to make money. And the way that they make money is through interest. So if you want to buy a house for $100,000, you're going to pay back that $100,000 plus X amount of dollars in interest. And that rate is going to be determined, one, the average rate that's in the market in general. And then what's going to happen is, depending on your credit score, your interest rate is going to be at that average rate or even higher. And the lower that your credit score is, the higher your interest rate is going to be. So if you're on that lower end, so if you have that 580 credit score, you don't expect to pay the best rate. You're going to have a higher interest rate because you are a riskier gamble for the bank. The reason why your interest rate matters is because you're paying back how much you borrowed plus your interest every single month. And so the higher your interest rate, the higher your monthly payment is going to be back to that bank. So your credit score can get you out of the game because, one, you need a minimum to even get in the game. And then second, if your interest rate is too high, it's going to impact your monthly payments, which is then going to impact your ability to get this loan because of something which most people don't even talk about, most people don't even pay attention to, which is your debt.